The Canadian ETF industry just kicked it back in 2024. It set new records both for assets under management and for inflows. And for the first time ever, ETF assets here went over the $500 billion mark. And it's very possible that you own an ETF if you're watching this video. So I want to break down the numbers and get into some detail here. Now, in 2024, the total ETF assets in Canada hit $519 billion. That was led by a combination of both strong market performance and also $76 billion in net inflows into the space. These were 45% higher than the previous record that was set back in 2021. And we remember 2021 was strong coming out of the COVID pandemic. Now, US stock ETFs, they were the dominant sector here, nearly $22 billion in new capital there. That brings the total assets in that category to $130 billion now. Second place, Canadian ETFs, they were followed closely behind, $102 billion in total assets. Now, crypto asset ETFs, this was the only category that saw net outflows last year. It lost about $1.1 billion overall. That's probably due to the increased competition from the US Bitcoin ETFs that were approved earlier in the year. Once again, ETFs outperform mutual funds in terms of inflows. That's now the third consecutive month that's been happening. Yowza. ETFs once again outperform mutual funds in terms of inflows. That's now the third consecutive year that they've dominated there. Mutual funds, when we look at that category, they saw pretty modest net inflows over the course of the year, $8.3 billion. That's actually in the first 10 months of the year. I'm really not sure why people are still putting all that kind of money into mutual funds, but to each their own, I suppose. Now, 2024 was also a record year of innovation in the ETF space. There were 224 new ETFs launched in the country in the year. That brings the total now of ETFs to about 1,500, and that's up huge from just a few years ago when I was in the business. We're just seeing new ETFs coming out all the time. When we look at actively managed ETFs, they now account for 53% of all ETFs. 31% of the total ETF assets fall into that category. We did also see 5 new ETF providers entering the market last year. Those include a couple from the US, a couple of big hitters there, JP Morgan Chase and Capital Group, and I'm pretty sure that we're going to be expecting more launches in this category in 2025. Now, not all of the trends were positive. We did see ESG-themed funds. So these are environmental, social, and governance funds. They saw net outflows of $1.6 billion during the course of the year, and that's a pretty sharp reversal from what we've seen in that category. They've been growing and growing, so it's a bit of a turn of the tides there. The Vanguard SP 500 Index ETF that led $6.2 billion in inflows, and that is a strong sign of investors' confidence still in the U.S. equities. And the CI High Interest Savings ETF saw about $2.4 billion in outflows, and that will be a direct reaction to the Bank of Canada's 175 basis point now reduction in interest rates. And also there were new liquidity rules for some high interest savings accounts, savings ETFs rather, during the year. And I certainly don't see that momentum in Canada's ETF market slowing as we head into 2025. The question to you is, do you use ETFs? Probably you do. What role do they play in your investment strategy? Let me know in the comments below. Now, I do want to shift now to jobs and the labor market in general. It is a big week for new data. The jobs report is coming out this Friday, and the latest unemployment reports from both Canada and the US, both countries are reporting this week. They are showing a sort of a shifting in the labor market, but I want to look a little deeper into this story. The big question I have is are we seeing the beginning of a sustained slowdown, or are we just seeing more seasonal fluctuations? I want to break that all down here, talk about what we can expect in the upcoming reports and what it means for you as an investor. So first off, a quick look back. The unemployment rate in Canada in November 2024, that ticked up to 6.8%. That's up from 6.5% in October. That was higher than expected, but in addition to that, it is now the highest unemployment rate that we've seen since September of 2021. The number of unemployed Canadians rose by over 87,000 people. That brings the total to about 1.5 million now. Employment in Canada actually increased slightly by 50,500 jobs. Now, in the US, the story is similar, but a slightly smaller bump there. We saw unemployment rise to 4.2% in November. That's up from 4.1% the month before. That is in line with expectations expectations, I can't help but notice here in Canada, the increase in unemployment was across the board. We saw young people, we saw core-aged workers, we saw older adults, all seeing the joblessness rates rise. Now, the labor force participation rate in Canada, that's how many people who could work are either working or actively looking for a job, and then you compare that to the total number of people who are old enough to work. That jumped to 65%, and that's its highest level in 3 months there. This means that more people are entering the job market, but not everyone is finding work. And because of that, we're seeing that uptick in unemployment that we looked at just a moment ago. Now, in the US, the employment levels there have dropped quite a bit. The employment population ratio fell to 59.8%. That's now the lowest rate that we've seen since way back in 2022. When I look ahead, both countries, as I mentioned, are set to release data this Friday. The Bank of Canada, they've already said that they are concerned about a weakening labor market here. The bank has already cut rates from 5% earlier in the year down to 3.25% now. The question is whether this deteriorating job conditions that we're seeing could lead to even more rate cuts. If unemployment continues to climb, I don't think the Bank of Canada will have any choice but maybe to accelerate that easing strategy to support the economy. But they're going to need to balance that with the inflation risks, and especially if we see core inflation remain as sticky as it has. So I think we're going to also need to watch the participation rate. If we see more people entering the labor force again, that could drive unemployment rates even higher, even if there are more jobs created. Now, in the US, the focus, I think, is going to be on the labor force participation rate to see whether that continues to edge downward. And I think that if we do see a sustained drop, then that could be a sign of deeper structural issues in the U.S. job market. The Federal Reserve there, they've already said that the labor market resilience has been a key reason for their relatively cautious approach to rate cuts. Now, for investors, this is why we're all here. Why do we even have to care about these numbers? Well, first off, if the labor market continues to soften, it could justify a pause or even a pivot in monetary policy. The lower rates that we're seeing from the Bank of Canada now, that certainly will provide some relief to the markets, but that will only be the case if inflation does remain under control. Also, rising unemployment, that often impacts consumer spending, consumer confidence. And if people start tightening their belts just too much, it could signal some slower economic growth in the months ahead. The key takeaway here is that you're going to want to keep an eye out this Friday for the reports to see what that might signal for the broader economy. Now, I will have a full report on the Friday numbers in this weekend's edition of the Pulse newsletter. I will put a link here on your screen so that you can subscribe in the event that you're not already part of that community. Now, lastly, for today, I've read some reports, interesting, not surprising, that shareholders at some of Canada's largest cannabis companies, so we're thinking of Tilray, Canopy, Aurora, SNDL, they're pushing back against CEO pay as the stock prices are continuing to fall. There are a couple of proxy advisors, so ISS, Institutional Investor Services Group, and Glass Lewis, they've been very actively criticizing the firm's executive compensation for not aligning with shareholder interests. And there's some very good examples. Before I get into those, first off, I want to look at a 3-year chart, and we can see the losses of these companies. They're going from down 67% all the way down to 96%. And if we look back over 5 years, that's even worse. I'm not so sure I want to even read these numbers out loud, but you can have a look at them here for yourselves. As you're going to see, though, these embarrassing returns, they certainly aren't reflected in executive pay. I want to have a look at Tilray first. Now, CEO Irwin Simon, he earned $10.14 million in 2024. That's US dollars. And that is actually a pay cut. It's down from $15.66 million in fiscal 2023 and $19.4 million in 2022. Now, meanwhile, here you can see how the company's stock has performed. That's the purple line on this chart here. So ISS, in this case, they call Tilray's compensation an unmitigated pay-for-performance misalignment. Shifting now over to Canopy Growth, CEO David Klein, his pay was up to $7.61 million US in 2024. We saw the company's stock dropping about 96% in the last 3 years. That's the yellow line on this chart. Now, over the past year, the stock has dropped 33%, but his income rose to the $7.61 million. That's up from $6.46 a year ago. And I will note that for all of these compensation packages here, the income does include stock and option rewards in addition to the regular pay. Aurora Cannabis, they also saw their fair share of criticism. CEO Miguel Martin, his pay increased to $8.02 million. That's an increase from the 6.72 million a year ago. Again, both ISS, Glass Lewis, they noted Aurora's stock losses of over 90% over the past 3 years, and they highlighted the growing CEO compensation as a understandable concern. Finally here, SNDL CEO Zachary George earned $10.28 million for the fiscal year that ended December 31st, 2023. Once again, that is a raise. That's up from the $8.16 million for the prior year. In this case, the stock has fallen almost 69% over the past 3 years. I guess if we look at it on the bright side, it actually did increase about 18% over the past year. And as with the other CEOs, stock awards make up a pretty good chunk of this compensation. So as the old saying goes, it's a good job if you can get it. I'm just not so sure is exactly what shareholders want to see. That will be a wrap for today's program. I'm here usually Mondays and Wednesdays with updates like this. As always, I'd just like to say thank you for watching, and we'll see you in the next video.